Welcome to Premium Cashflow Real Estate Investing Podcast with Sakar Cowley. During this program, you will hear guest experts sharing their experiences, best practices, and market insights. We discuss investing in multifamily apartment complexes and how a busy professional can passively invest hassle-free in various opportunities. Your host, Sakar Cowley, owns millions of dollars of assets and has done thousands of value-add projects over 20 years now. So listen in for insights. Here's your host, Sakar Cowley.
Welcome to another edition of Premium Cashflow Podcast. Today, I have the pleasure of speaking with Scott Choppin. He's the CEO and founder of the Urban Pacific Group of companies based out of Long Beach, California. They are a real estate development company. It is founded in 2000, and they exclusively focus on workforce rental housing communities throughout California and the Western US. Their company has created a new housing innovation called Urban Townhouse, which pairs the private capital with middle-income, multi-generation rental housing while producing market superior yields on invested equity. Historically, their company projects have delivered a 22.66 or just about 23% programmatic IRR yields on equity, which is extremely stellar that as we all know. Over 35 years being in the business, Scott is a leader and a regular contributor to major news outlets. He has published articles in Forbes, Globe Streets, LA Times, Builder Magazine, Affordable Housing Finance, and the MultiFamily Executive. So boy, the list goes on and on. So thank you for your time. And Scott, lives in Long Beach happily with his wife of 27 years, 3 kids, 19, 16, and 13. And boy, I mean, we are going to have some, lot of educational fun today. So thank you for your time, Scott. Please tell our listeners, Scott, a little bit about your background and how you came about into, sort of the Urban Pacific company and the niche you focus on right now.
Sure. Thanks, Sakar. Glad to be here. Thanks for the invite. So my background, really, I grew up in a family that was in the real estate development business. My family's been active in real estate development in Long Beach since 1960. Mm-hmm. So I had the great, opportunity to, grow up around the business. Although, when I was young, that wasn't necessarily going to be my career choice. But as I matured and started to determine what career I wanted to pursue, real estate development really became really the primary and ultimate focus of my career and what I still do now, all those many years later. Mm-hmm. So I basically began my career working for a couple of significant real estate development companies. I worked for a subsidiary of a company called KB Home, or it used to be called Kaufman Road back in the days. And I worked there for a guy named Mike Costa in their multi-housing group. And that was a unique, retail, not a retail offer, but a subsidiary of this home building company that built and syndicated apartment projects. So it was completely unique offer for that company. I was there for a few years. Great working with Mike. In fact, still do business with him now. Then moving forward, I went to work for a company called Saris Regis Group in Orange County. Another, well-known regional, really West Coast apartment development company. Mm-hmm. They do industrial as well, commercial. I was on the multifamily development side, heading up their, multifamily development operations, or really, the real estate development process with them. And then in 2000, late 99, I left Saris Regis to form what is Urban Pacific Group of Companies. Mm-hmm. And we really always were focused on the urban infill real estate development environment. So back in 2000, it was developing different housing assets. We've always been a housing developer, really an apartment developer, if you look at our history. but we always pursued projects that were in urban infill locations. So urban, what you'd expect in the city, right?
Sure.
In existing neighborhoods. But infill is a terminology where we're looking for projects that use vacant parcels or underutilized parcels in the existing urban fabric. So we're not going to go out to green fields or on the peripheral areas of a city. We want to find projects that are inside, the already existing fabric. And that's sort of a unique offer. Not so much today. I think it's more mainstream, but definitely in 2000 when I formed the company, it was really just a handful of companies that really did that and really understood the urban dynamic well.
It is absolutely a
then,
very challenging space, right, Scott? I mean, going into infill housing and, let's say if you're raising an existing, older building of sorts, or perhaps if you have an empty lot adjacent to like two high rises or something.
Right.
I mean, and we all have seen those projects, and I can imagine how challenging they are. So please go ahead with your story.
Yeah, no, it is. Well, it's interesting, Sakar. It's a great question because in some ways it's more difficult, right? So I think things like environmental issues on sites, like let's say it was an old gas station, you have, an underground tank that you need to deal with. You might have existing tenants in the building that you need to vacate to get ready. But in other ways, it's actually easier. And particularly in California, we have a very difficult entitlement process. So entitlements would be rezoning the property. In California, it's something called the General Plan Amendment. And in that case, actually, the city is easier because it's an already existing fabric for the most part. And I'm generalizing. For the most part, when you go develop an underutilized site, in many cases, the neighborhood's okay with it. Now, not always, again, but in many cases, it's easier versus if you're, on what we call a green field, right? Never been built before. You might have neighbors around that want that to stay as an open green space. Maybe you might have, animals or, insects that are, endangered on that site. And so in many ways, it's more difficult. So we've always found the challenges to be appropriate challenges, appropriate meaning ones that we can resolve and be profitable, right? Ultimately, as a real estate developer, we need to make good site assessments, build profitable projects, pick the right markets and the right tenant base in order to produce viable projects. And so I'll stop there and see what other questions you have about that.
Sure. It sounds like from your bio, Scott, that you have always been into multifamily new development in one shape or the other. Sounds like, right? And that's absolutely unique, actually, to have a sort of a real estate background from the start, from your father, like a family background, and then as you're starting your young career, right? You are also teaming up with other developers developing multifamily. That's quite unique, and I haven't had a guest as in-depth background as you have, specifically into multi-family like new development. So I would like to maybe ask you some questions around it, Scott, as to how different it is from a sort of a planning perspective, or perhaps even the I don't know whether you're rezoning it or anything, because I imagine that let's say in a single family sort of a subdivision development, as we say that we are going horizontal, meaning you're laying your utilities and whatnot, and then we go vertical for all our sort of construction of sorts, right? So the horizontal and the vertical, but I guess when we are going into multifamily, whether it is, I don't know, whether like a high rise or a garden style apartments of sorts, right? Could you maybe help us understand how it differs versus, let's say a traditional single family subdivision of sorts?
Sure. So what's the difference between developing multifamily versus developing like single family, we might say?
Sure.
No, it's a great question. So, when you do single family subdivisions or land development, so first let's differentiate between land development and, vertical development, and people don't call that, but, the difference between land development and actually, building buildings, right? That would be the way to differentiate it. And you described it a little bit in your earlier point with, horizontal versus vertical, right?
Sure.
So in single family, you typically have, not always, but typically you have a separation between land developers and home builders, right?
Right.
Land developers, they do the entitlements, they do the subdivision maps, they may do rezoning if that's required. And then they'll come in and they'll do the utilities, infrastructure, maybe they'll do some streets, and then they'll sell lots to home builders, right?
Right.
And the home builders come in, and they're particularly the public home builders, they want to buy a ready to go product, right? They're to build vertically and sell homes, right? Almost like a manufacturer, right? Is the way I think of it.
Right.
So, and sometimes you have the combination. You might have a land developer that also does the build out. But I think particularly in the institutional world, publicly traded companies, home builders want to just, they want to manufacture homes and sell it, right? Very much a production orientation. Now, on the other side of it would be multifamily, where usually the developer, they may buy land from a land developer. Maybe you buy a multifamily parcel that's part of a larger mixed use project, maybe some commercial, hotel, multifamily, right? But I think more often in my mind, you would find multifamily developers that really end up doing the entitlements, if that's required, and the infrastructure and the land development portion. And then they also do the vertical, right? It's sort of a, all in one process. And in fact, I described that way because that's exactly how we operate. Right. Now, one of the things that we do, because we're in essence vertically integrated in that way that we're describing now, we do entitlements, like we do rezoning processes, and actually historically have done a ton of it, a lot of it. But in the last few years, particularly around our urban townhouse model, we actually are selecting sites that don't need that. We purposely are only purchasing sites that are what we call by right, which basically means the zoning's already correct and you just need to do your construction drawings and submit to plan check. And we did that amongst other things to simplify or expedite or make more efficient the process of producing our projects. Because at the end of the day, reducing complexity in the real estate development process, to me, is the thing that is the best for the bottom line. In fact, the saying I have, Sakar, is complexity is the enemy of profits in real estate development, right? So if you want to be profitable, profitable, you got to simplify. Now, it never is simple, right? It's never easy. It always has this challenge. But what you want to work on, maybe call it risk mitigation, maybe another way to describe it. But I'm looking at taking out of the process what I call friction. Right? Friction would be if you have to do a rezoning process, right? That's friction. And if you say, I only buy sites that have zoning, then you take that friction out, right? In our construction cycles, right? We also, build our projects in-house. We look to reuse the same unit plan over and over again. In fact, we can talk a little bit later about our, the model UTH, which is a 5-bedroom, 4-bath townhouse rental product. But the point I'm making here is that we really want to use the same specifications over and over again, use the same subs, use the same architect, civil, and other vendors, so that each project gets more and more efficient. I mean, we're now several projects into our UTH model, now going on 3 years of delivering this, private capitally financed workforce housing model. And we are probably the most efficient that I've ever seen our operations really in the entire history of our company. And not to say that we didn't always seek out efficiency, but particularly in urban projects and doing what are called podium projects, think mid-rise, apartment housing, new construction. Each site was different. Each building was a one-off design. Now what we do in our UTH model is each site is different, as all sites are, right? A land site, but we'll put our same unit type in, maybe it's a building of 3 units or a building of 6 or building of 10, but we lay those out across whatever site we have at the time and make the plan footprint that we do over and over again, the UTH model, fit, how many ever units we can on a given site. So we're basically designing the UTH model to fit on any given piece of land, but that's the same unit type. So all those add up to efficiency. And there's several others that I won't go into now. We can talk about it if we want, but really ultimately we're trying to simplify, making the process more expedited, more efficient, so that basically at the end of the day, we can turn around and complete as quickly as possible reduced time periods so we can get to income production through rental of units, right? At the end of the day, that's what we're here to do.
Sure.
And then start to generate yield for our investors.
Interesting. Thank you. Thank you for that clarifications there, Scott. Now, you mentioned several times, Scott, about urban townhouse, model that you have, right? Let's go into that. Like you said that you do infill projects, right? Now,
Right.
I want to kind of ask you some contrasting question here. Like, personally, I have done lots of repositioning where we will take townhouses or, sort of the mid-rise buildings and sort of gut renovate them, for lack of a better term, right? And here you are doing a completely brand new development, and that too an infill development. So for a novice eye, right, it sounds pretty complex as it is, right? But from a cost and a return perspective as well, it definitely is, has its complexities layered multiple times, right? So give us a sense of why not just do, existing buildings and renovate them, as minimally and as effectively as possible,
Sure.
versus doing the new development or, sort of your style. So I'm just curious to know your thoughts on that.
Yeah, so that's a great question. And so the way I think of it, Sakar, is really you have value add, right? The remodel that you describe, and then you have new construction, right? These are the sort of categories we're talking about generally. Where I go with it is, I today, particularly in the era we are in now in June of 2020, I really, we created the idea of recession-prone assets versus recession-resilient assets, right? And I think everybody today who's listening to this program, as we're in the coronavirus recession of 2020, really everybody moves immediately to the narrative of, I want to go find distressed assets, right? And particularly anybody who went through the 2008 recession, there was a fair amount of that product. Okay.
Sure.
And so what I start to think about and how we differentiate our urban townhouse model, and this gets to the logic that you're asking about, well, like why do this new construction versus value add, is that ultimately as a new construction developer, I get to have certain advantages that a value add sponsor or deal maker, they can't take advantage of. So one of the things that I describe is we're able to build new units in any market that we want, that we choose, of course. So we're assessing the markets very diligently. But at the end of the day, as a value add investor or sponsor, you are only going to be able to buy the assets that are either on the market actively or projects that you find, off market, right?
Right.
But you're stuck with the neighborhood. If you wanted to be 3 blocks over, really go, gosh, this value add asset is great, but I really want to be 3 blocks over because it's a better neighborhood. I, as a new construction developer, I can go 3 blocks over. Now, maybe there's no land there, right? Maybe there's no, capability to develop there, but I have the advantage of being able to move my project. Now, I don't literally move it, but I move my choice, right? So there's one. Another one is basically what I call programming. So what's your unit mix and what's your unit types, right? As a value add investor, you're always going to have to buy what the project has, right? If it's got all studios and that happens to be the neighborhood that you want to be in, and the timing's right and the price is right, that's all good, but you still have all studios, right?
Sure.
Now, maybe you could combine 2 studios into 1 bedroom. I mean, people do that, but I think that's less common. For us, we get to design exactly what we think is going to fit the marketplace at that time, but also what we think can be stable and recession resilient over the long run, right? So our urban townhouse model is a 5-bedroom, 4-bath townhouse rental unit, garage on the ground floor, bedroom, bathroom, one of the 5 is on the ground floor. And the reason that we design it that way is because we want to serve working families that live multi-generationally, right? So commonly, outside of the United States and then historically in the United States, people didn't live in our classic nuclear family that we know so well here in the US, and we're certainly moving away from that. But if you have a family that lives multi-generationally, that has grandma at a grandpa at home or older in-laws, and you're building a studio unit, you can never serve that family. They couldn't live in your unit, and you wouldn't want them to, right? You don't want, too many people. But we're able to really custom design and place our units to serve those families or whatever we think is the right tenant demographic, right? So we have that advantage. One of the other advantages I think about is when you're done with it, we hold all of our projects long-term hold. So we raise capital, normally from investors, high net worth, and family offices, but we hold long-term, really 10 years and beyond. We have a brand new asset. Day one, it's today's code, it's today's systems, it's today's technology. And so we can have a much longer life cycle expectation of that project, right? So those are some of the differences that I think about. And so why recession prone versus recession resilient is because ultimately when you buy, say, that existing asset that's distressed, well, it became distressed for a reason, right?
Sure.
Whatever reason, it's going to be different. But let's say it's all studios in a marketplace that doesn't really have great demand for studios. Yes, I can buy it at a discount. Yes, I'm getting a great deal, and maybe it's enough, margin in the discount to like be fairly solid, like however it performs. But where I go with it is, does that project become recession, impacted again in the future?
Right.
Because the long-term trend says that studios really are not appropriate. Now I'm speculating. Every market is going to be different, right?
Sure.
Versus us, where we think our product particularly, but we focus on recession resilient assets, is what are products that actually perform better in a recession, right? And our UTH model is that in one way, which is that we're the place where single earner households, say adult kid, basically moves out of their apartment because they can't afford it anymore, and where they go, and in part is they may move in with their family, or they may move in with roommates, right? And this is overlaid underneath a recessionary environment, right? Our unit is where people come to combine together, and we call it recombination is actually the distinction we use for it. That could be a recombination of a family group, say grandma's moving in, or adult kids, boomerang kids move home, or it could be roommates, right? And in fact, we have a name for that. We call it economic sharing. So they share incomes and expenses across the family group.
Sure.
Right.
And as
fact,
you described,
another name for this.
You said it's a 5-bedroom, 2-bath model, right? So obviously it is
5-bedroom, 4-bath.
Wow. Okay.
Yeah.
So it certainly is serving a sort of a larger larger family. And as you rightfully said, that multiple folks sometimes within the family are coming together, or sometimes do you find that maybe unrelated adults, or professional working class folks also rent these units?
Like roommates?
Sure.
Yeah, we certainly do. I mean, our intention, is to serve families, right?
Sure.
Really, we have a certain, ethical standard, ethical meaning, standard conduct that we decide for ourselves, like, standards of conduct for ourselves. But if roommates come together, and, obviously if they qualify in our, through our property management team, then we welcome them, right? We don't resist that necessarily. But particularly one of the things that's unique about UTH Sakar is that we're actually building, and we're sourcing land and building in B and C neighborhoods. So
interesting.
What that means is that we're usually locating new projects in neighborhoods where the family demographic that we serve already lives there. So these would be middle income, blue collar families, living in a B or C level neighborhood. I find more often that professional roommates, when they're particularly generating higher incomes, usually will seek out like better neighborhoods. Right. And nothing wrong with that. It's completely coherent. We just say that's not necessarily the demographic that we choose to serve per se. Right. So there's no, and again, I have no opinion about what's right or wrong. There is no right or wrong choice for those tenants. They're all valid, right? We just say, look, we want to rent to families that do economic sharing, that work in the service industry, that have strong social networks around the neighborhoods where they already live. So kids in school, extended families close by, churches down the road, and particularly jobs are close by. Usually our tenants on average are commuting only 10 to 20 minutes from wherever the housing is. They choose housing that's co-located at their job. what I say, when you have that style of tenant, they're very stable. In fact, we
Absolutely.
describe them as sticky, because they basically, when a recession comes or when changes happen, they generally stick, right? They batten down the
Absolutely.
hatches, they economic share. And
Sure,
I
sure.
just say, look, I want to rent to those stable families as a choice, as the business model, versus
Couldn't
professionals who will be more mobile and move more quickly.
couldn't agree more. I mean, I see within our portfolio as well. I mean, we have the houses and the townhouses, and we have the apartments, and we'll see the cyclic nature within apartments, but within townhouses and single families. I mean, same families tend to go on for years and years. I mean, in fact, in house, we have some families that have been with us since 2006 or seven, actually, believe me or not.
Right. So very long-term tenancy in those type of units then,
Absolutely,
right?
absolutely.
Yeah.
Now,
Yeah.
Scott, give us a sense of how many units you have built in the last, I guess, 3 years, and what today's sort of the supply pipeline looks like. Is it something, very much available? And again, I want to just preface this by saying that we are talking about infill urban projects. So, these are not sometimes readily available. So I would be curious to know, how many you built and what sort of pipeline it looks like today.
Sure. So historically, as a company, we've developed several thousand units of apartment new construction, sort of like you described in the introduction. And then about 3 years ago, and most of that was urban infill, sort of like we talked about, usually much higher density, over 100 units to the acre, a product type we call Podium, which is like a mid-rise, say 4 levels of structure over a parking garage, right? Like in infill areas in the city.
Sure.
And we did a bunch of that, got really good at it. But about 3 years ago, we noticed that the market was starting to mature in that space. So in other words, a lot of developers were coming into that space, a lot of very good names, the Trammell Crows and the Holland Partners of the world, really, really powerful companies. And it's always been our style that we are always looking for the niche undersupplied market. Where is there high demand and low supply, where it's not being competed for greatly? So we're always looking for that space and innovating to try to create products around that. So 3 years ago, we basically, several events happened that sort of guided us into what is now the UTH model. But particularly, we sourced a site in Long Beach, in our hometown of Long Beach. We have a great relationship with the city there, and we're able to buy the land actually from the city of Long Beach. They owned it for very, very good price. Like, I think we ended up paying $45,000 a unit.
Wow.
The zoning allowed. So we had this great purchase. Like we just purchased great. Again, this B and C neighborhood, right, adjacent to downtown Long Beach. But interesting enough, the land price gave us the ability to experiment. This is the key to the thought process, right? So we couldn't like mess it up too badly and still not break even or make money, right?
Right.
So the zoning for that site allowed a certain unit count, but it didn't have any restriction on the size of the units, interestingly enough. And we hadn't come across that before, just a unique sort of characteristic of the zoning in that particular neighborhood. And so when we started to design the site and working with the architect, I sort of was going, well, okay, we're limited on unit count, but we can do any unit we want. I go, well, why wouldn't we go, let's look at a bigger unit, like, more bedrooms. To me, I could generate more rent with that, right? So we ended up, that was the first project that was in the UTH model, or the UTH business plan, right?
And Scott, how much is the square feet of this UTH model in interior? Just so that I understand how big these are. The square foot of the model itself.
Yeah, the square footage is what you're asking. Yeah, so the units that are standard UTH model is 1,750 square feet, 5 bedrooms, 4 bathrooms. Just a little description: 2-car garage, 2-car private direct access garage on the ground floor. So these are a townhouse unit. So they're built to rent, but they live like a home, right? You live above and below yourself, right? So to answer your previous question, sort of like, pipeline and how do we get to that? In the very beginning of this business plan, when we came finally to arrive at the idea that this UTH model, this big bedroom count town, it's going to, be a plan that we wanted to work more on, we actually put together a small group of 4 projects, which we call the demonstration phase. And we purposely bought very close to, our offices in Long Beach, in areas that we knew really well. And we ended up completing the first 3 projects and sold each of those for around, on average, about $500,000 a door, which, whatever market people might be in, that may not make sense. But in California, that's actually a very good price per door.
Sure.
And it happened to be that because the units were so large and we generated so much whole dollar rent, that the limit for the appraised price and sale was not square footage or the cap rate, but it was the per unit comparables in the marketplace. And so we got sort of hit the upper limit of it, a per unit price, coherent on a per square foot price valuation, appraisal, and sale. And then interestingly enough, when we sold these projects, although we were reaching peak market prices for sale, the cap rates that people were buying at were like 5.5 and 6 cap rate for a brand new product in California, which was amazingly
Sure.
really good value, meaning, they were sort of buying new product at a discount to the market, right? Because cap rates are, were at the time 4% and below in some cases. So we actually developed several small projects in that pipeline. This is answering your question.
Mm-hmm.
And the first 3 we sold. And then the 4th one we're actually finishing now. And we're actually going to hold that. About 18 months ago, we made 2 assessments. One was that a recession was coming.
Sure.
Right? We didn't know when or what the nature of it would be, but we were anticipating that, we were on the longest economic expansion in U.S. history.
Absolutely.
Certain signals, the yield curve had gone negative. So we were anticipating a recession. So we said long-term hold puts us in a defensive position. If we have stable tenant base, like I described before, sticky families,
Sure.
that we could ride through a recession. Valuations may fluctuate, but from 2008, we saw that NOIs and rent levels in Southern California were relatively stable, right? So we go, hold it, don't have to sell it, stable income. We can ride out over the long run valuation changes, right? So it's sort of a defensive mechanism. But ultimately, we made that decision really more importantly, is that we believe in this model so much, Sakar, that we're like, we want to own everything that we build. Okay.
Interesting.
So we finished that demonstration phase, and now we're in the production phase. And so we have several new projects. So I think all total, we're coming up on 10 projects total.
Wow. Nice.
And our project sizes range anywhere from right now on the low end around 15 units up to one of the larger projects so we're working on is 85 units. And I think we'll sort of continue in that range of project sizes. And in fact, in this recession that we're in the last several weeks, we actually think there's a story to do, more small, close-in projects in Long Beach to remain very nimble. Small means we can execute them quickly. We can buy zone sites like we talked about before. They're close to our office, so they can be managed much more simply and easily. And now we're just going to go do a bunch of those. And that's supported by the fact that really the business plan, the UTH business model is accelerating. So we talked about that recombination idea before, that economic sharing model.
Right.
So we're seeing even during this coronavirus lockdown, or now we're coming out of it, that we're able to lease units at good velocities, meaning the absorptions were
pretty good,
stable and productive. And in fact, in the Fullerton project, which we're leasing up and about to occupy them in the next month or less, we're actually above pro forma in our rent. So in that case, we underwrote $3,500 for that 5-bedroom, 4-bath unit, and we're actually achieving $3,800 a month. So $300
Nice.
above pro forma in a recession, right? So we're a counterintuitive offer, Sakar, where we're actually accelerating. We're one of those products that are accelerating during a recession, not being, distressed. That's where the distress resilient idea came from.
Right. And pretty much hallmark of, low supply and very high demand. That's for sure. Right. Now, Scott.
Right. Yeah, that's right.
for your the larger 85 unit that you're doing, or perhaps the mid-size that you may have, right? Are these like sort of co-located in terms of like, 4 units in a building and 4 units? Give us a sense of how they look physically.
Yeah, so great question. So I alluded to it a little bit earlier, and it's hard for me to describe it, but I'll do my best. So we're using that same footprint, that same 5-bedroom, 2-car garage footprint. Our unit's generally about 23 feet wide by about 35 feet deep, and I'm giving you rough numbers here.
Sure,
And,
sure.
it depends a little bit on the. So all we do is we'll get a piece of land, Sakar, and we just lay out that unit type in some group of buildings. So maybe, if you have like let's say a triangular site, those are hard to lay out.
Sure.
As the triangle comes together, you actually will fit units. So you'd have 3, and then you'd have 5, and then you have 10, right? As you move away from the constricted corner.
Sure.
And so we just basically take any site, and we look to lay it out with modules of different unit counts in a single building. So it might be 3, it might be 5, it might be 7 units in a building, right? And then we just lay out the driveways and the open space and the unit layouts to maximize efficiency of unit count on a given piece of ground. In fact, on average, we generally yield about 22 units per acre. So we can look at pretty much any site and just say, if it's an acre, we know we're going to get 22 units on it. There's some qualifiers, right? Again, that triangular site's going to be less efficient. So maybe we're getting 20 to the acre. Our perfect site for developer is, a flat square 2-acre site, right? Just really simple to lay out, good street access. In those cases, maybe we could be above 22 per acre a little bit. But for our rough numbers, when we underwrite deals in the beginning, when somebody sources a deal for us, brokerage, networks that we have, cities that bring us sites, we can do a very quick, analysis of, hey, we can lay out, we know 22 the acre, we can get this many units, we'll assess rents, we can underwrite a pro forma, we can do all that within, less than an hour, right? If the team is, available to sit down and run numbers. But we have one of the advantages of this production model, right? This efficiency, this lessening of complexity, is it allows us to underwrite new projects very, very quickly, because we have such good understanding of our layouts, of our design costs, of our build costs, right? Everything is so well documented and efficient, really production oriented is what I mean when I say that,
right?
That we can very, very quickly assess new projects. And our job really is to, identify a good site and underwrite it very quickly. And it's either a quick pass or hey, it's going to make it to the next step. And then we'll maybe get it tied up and go into due diligence in that kind of process.
Give us a sense of the cost, Scott. Now that we are on that topic, I want to ask you, explain us what goes into the design phase cost, your construction cost, and also if you can clarify. We are talking about, build to rent type of models, right? This is not your glitzy model type or, Class A type of construction. So give us a sense of cost and how you achieve some of those efficiencies by using like a rental grade product of sorts.
Right. Yeah, no, it's a great point. So we've actually explored the idea of our new housing, in the industry, you say you've got an A product, a B product, and a C product, right? New construction, luxury is almost always A, right? As people talk about it commonly, but I don't look at our product as a product. Now, it is a nice product, right? We use quartz countertops, we have, production grade cabinets, but they're nice. They've got self closers, we use, GE appliances, good quality product. We have great vinyl plank flooring with, it's that new type of vinyl plank flooring that's waterproof.
Sure.
And in fact, we're starting to use that throughout, move away from carpet anymore, just because the hard surface, this vinyl plank flooring looks great and it wears really well. And it's because it's an epoxy resin base that you can pour water over all day long and it performs well. So, and then beyond that, we're typical, finishes for your standard apartment grade. Like if you looked at our apartments, you wouldn't look at them and go, gosh, those are real low quality, right? I mean, we do build them that they look, high quality, but we're not luxury. So, we don't have tile, bathroom, tub, shower enclosures. Ours are fiberglass, so very production oriented, right? But really very much in keeping with, some markets in the US, where you wouldn't be able to achieve luxury rents. These would be similar finishes that you would see in our projects as you would in those other markets. We just happen to do it in California, right?
Sure.
So, I'll be a little bit, circumspect about the cost because it's, something that we sort of hold proprietary.
Sure.
But just say like our hard cost per square foot, average is somewhere, between the range of about, 110 and 130 a foot. And that's all in. And so remember we talked about.
That's extremely efficient.
It is. Now, I think there's some people in Southern California that actually do better than us because they do a lot more units. So they have like higher volumes, and we'll get there too once our volumes increase to the level that we have planned. But we build like a home builder builds. In other words, we don't use a general contractor. We manage the construction in-house like a home builder does. And then we contract directly with the subcontract markets. That's how home builders typically do it. Why call it that way? In fact, we describe it internally as the CM prime model. So we as the developer, the CM, right? We run it like a GC, although we don't use our GC license in a legal sense in the contractual chain. But we manage it like a GC would, right? Superintendent, have project managers, project coordinators do the contracts. But we buy the work direct from the subcontract market. So we cut out the middleman. There is no GC for us. That's one of the ways we're able to keep it cost efficient. And this is a proven model, right? Home builders use this all over. Any big home builder across the US, this is exactly how they work because they have to keep it efficient. They don't want to pay a general contractor to mark up the subcontract pricing, right? And so we've adopted that model. We've been actually doing that since 2005. So we've been doing it for quite a while right now.
Sure.
So that's a good range. Now just something to qualify. That price that I gave you is all in, meaning that's all the demolition, grading, all the vertical work. That includes the, occasionally we have to do street utilities. But part of it, our work that we do, because we're in the infill environment, we're not running major utilities for half a mile of a water line or
they're already
line.
there, right?
It's already right out in the street in front of our site. In fact, the longest we've had to go in the last several projects was like 20 or 30 feet to the middle of the street, right in front of our site.
Right.
We run them on site. As the water comes onto site, we do the on-site distribution. So that price I quote you is for everything, not just the vertical. This is, all the horizontal and the vertical, if you will.
Right. And considering California and the knowing how expensive the labor is and everything, I mean, that's a really efficient price. I can tell you that.
Yeah. Let me share also one thing that we're seeing right now. So again, back to this distressed prone versus distressed resilient. So we talked about the performance of our leasing and velocities and rental rates is very solid right now. We are looking forward, and in fact, seeing now more acceleration in that business plan because we have in the recession now reduced land prices, right? As you'd expect in a recession.
Sure.
And then to your point about, labor cost, is that we're already starting to see a reduction in subcontract prices because the amount of housing that's being developed in California has reduced because of the pandemic, right?
Sure,
people have shut projects down. Now, I think we'll probably recover relatively quickly. It looks like the economic, shape of the downturn may be more V-shaped. Seems like what's happening right now, at least from the most recent indicators. But I will tell you what, Sakar, it's been amazing. I mean, we experienced this in 2008 where subs basically had less work. And so that has them be more efficient in their labor cost management, and also their margins, their profit percentages. They want to get work. They want to keep working. So they got to tighten up their budgets and their margins.
Sure.
We've seen a huge acceleration in our construction activities because from the pandemic, a lot of labor became available very quickly.
Absolutely.
And so And I don't enjoy the fact that happened. In fact, I'm, for me, it ethically, we go, look, we don't wish to see people in that situation. But I'll tell you what, we're so happy to be able to keep people gainfully employed on our projects.
Sure.
Construction remained an essential activity in California. We're very fortunate that way, and all the cities we worked in remained open. And in some cases, we doubled the crews that we had. So our framer basically almost double the amount of labor that he was able to supply to our project, which is probably at this point going to cut around 3 months off of we were going to build in 12 months. This is a Montebello project. We're going to be in about a 9-month cycle. So we shortened up dramatically. So we, lower land costs, lower construction costs, more expedient delivery of construction. All those really drop to the bottom line. If you hold all else equal, meaning rents, are stable, renter profile stable. We got projects, and we're fortunate that we have lenders that remain, construction lenders that remain really loving our UTH model. They see the viability of it in the recession. Awesome. So, this isn't us patting ourselves on the back. I just am so, have so much gratitude and a positive feeling to be able to keep people employed, to be serving these families that need this housing in this time of pressure from the economy and the recession. And, we can continue to deliver profitable projects. So we're actually in an expansion mode right now.
Awesome.
And we'll be continuing to raise capital, around these new projects that we develop.
Sure. Now, Scott, before we run out of time, one last question here. How is the investor appetite for this product? Meaning, passive investors investing in your projects and things like that. How do they perceive this, and what do you see? Like, is there a great demand? I mean, you have lots of capital knocking on your door.
So, we're a company that traditionally moved in the institutional capital world, right? If you look at our several thousand units that we've developed over the history, they're almost all predominantly institutional capital sources. Over the last 3 years, as we've developed this UTH business plan, it's really given us occasion to start to build networks of investors in the high net worth, small family office, high net worth family domains. And so we're very encouraged by that. We continue to grow that network and want to grow it more. So to answer your question, we've actually had very good success. So we just had a project, 1491 Atlantic. In fact, we're about to close out the final equity piece. We ended up raising the capital. It wasn't a very large project. It was $500,000 of equity. So, relatively small deal. But we ended up raising that. I think we're at $450,000 after about a couple of weeks of raising capital on the deal. So very quick. The investors, when we talk, this is part of the reason that we developed the narrative of recession prone versus recession resistant, because we knew when the economy changed, what we anticipated that these families would be relatively stable. Now, we couldn't have anticipated that the service sector would be hit as hard as it has been, restaurant workers, retail, right? But we're also seeing that that's rapidly recovering, right? In these, in some of these job gains, historical job gains that we're having right now. So as we talk about the differentiation between distressed asset investing and new construction investing, of course, most sophisticated investors go, oh, this is the time for distress, right? I mean, and that's appropriate. And there may be distress like we anticipate, and we saw that in 2008. But really, we're in conversation with investors, and this is really the way that we're able to attract them, but particularly for investors that have very long-term hold objectives. So like, say, a family office or really high net worth individual investor who has a long-term hold horizon. The idea of investing in a stable, long-term renter base like these working families and an undersupplied story, like you mentioned before. I mean, in California, we have such a difficult entitlement and development environment that we're probably never going to catch up to our undersupply in certain market spaces or this workforce, maybe ever, or it may take several decades. And we're suffering from undersupply generally over the last several decades. Right. We're making some moves now to create new laws, but the reality is politics and economic cycles along these are very slow to change. So we see long-term viability, stability in that particular renter profile, and then you get to invest in a brand new asset.
Absolutely.
So we're having good success raising capital. I mean, we need to meet many more new investors, right, to fulfill the capital needs that we're going to have on a go-forward basis. But we're encouraged. It's great to be able to have a story that has economic viability, meaning we have renters who want to rent, we have investors who want to invest, lenders that want to lend. This long-term, stable story of these renter families, but also it's got great social characteristics, right? So we're able to serve these families coherently with their lifestyle and keep people working. Not only keep people working, but we actually can employ more new people. So I'm very encouraged to be able to speak this narrative in this particular time in the recession and this part of the economic cycle, vastly different than 2008, where housing was highly damaged, particularly the for sale markets. And a lot of people did leave for sale and go into the multifamily markets, by the way, at that time. That's what had multifamily be stable in 2008. We anticipated that it would be the same in the next recession. I think we're moving more long-term to, more renter families, more multi-generational families living multi-generationally, like the statistics for that are rising. So all these things add up to, I think, a very positive combination. And look, Sagar, we don't sit here and say we're bulletproof. Gosh, it's all, unicorns and rainbows. I mean, we have to be vigilant. We have to anticipate and always be looking for whatever breakdowns in the economy and renter profiles. But we're always continuously assessing that. We use economic tracking tools very, very, very disciplined way. We're reviewing weekly. We do, market comparable updates on rents, like almost constantly. Used to do it every 3 months. Now we do it once a month. Just to be careful that if any signal starts to go against our model, that we can see it early and anticipate and plan for it, right?
Absolutely.
And so far, we've been able to do that, with relative success in today's environment. Awesome.
And you're correct, Scott, that we have to, always monitor regularly and see what may pop up. Now, on to the, just one last question there, Scott, please share with the listeners, how they can find you and learn more about your company and everything.
Sure. Yeah, appreciate that, Sakar. So I would encourage everybody to go to our website. It's www.urbanpacific.com. When you get there, look for a couple of things. So there's a red button, sign up for our Saturday e-blast. A lot of great information about the multifamily markets. We share all the articles that we read and find ourselves about the economic cycle. We're showing people how to look at development deals, how to assess them as an investor, think investor education. Then I would also go on the website, go to our investor education section. We have tons and tons of articles, videos, podcasts, just tons of data, really, centering on educating investors to, be better investors generally, but also to be educated in the new construction investment, arena. And then the last, there's a contact page on there on our website, Sakar, and people, my personal, my corporate, but direct emails on there. And then my cell phone's on there. So I encourage people, if they're interested to talk and reach out, they're welcome to email me. That's going to get best response. I have a team of folks who help me with that. And then if people want to text me on my cell phone number, I welcome that as well. So, we're immediately available. And then go check out our LinkedIn page, LinkedIn/Scott Choppin. We have a company page, and then also take a look at our YouTube page.
Awesome. It's been a pleasure, Scott. I appreciate you coming on to the show, and I look forward to chatting more on your for more information. Thanks a lot.
Yeah, thanks, Sakar. Appreciate it.
Thanks for listening to Premium Cashflow Real Estate Investing Podcast. Please join us at premiumcashflow.com to sign up for weekly updates, research articles, and more. We will see you again for another great interview with an expert guest.